How are you doing, ladies and gents, boys and girls? Back for another webinar. Let's let people join and we'll get started at 6 o'clock on the dot. Wow, what a busy day. Well, do you know what, actually? More of a gap up and sit there and dip a bit, rally a bit. Dollar yen absolutely flying. Gold pummeled. Crude rallied, dropped back. NASDAQ flying, although has been flagging around the VWAP pretty much all day, making a late run now. Lots going on. Obviously, if you've been hiding under a rock, you will not know that there has been an announcement from Donald Trump, trade breakthrough or trade deal, tariff breakthrough, whatever you want to say, with China. Blah, blah, blah. I'm not going to regurgitate what's going on. Needless to say, risk on environment. We have a massive gap up, which is holding so far. So let's see where it closes today, where we close the week. It's still early. There's no rush with anything. Loads of opportunities around. Anything can happen. It's a very news-driven environment. Just manage the risk, keep things, I say tight, but be careful not to overdo the tight stops, and just stick to the process, man. And if this is not your thing, you wait until it settles down and calms down and wait for your opportunity. If it is your thing, press, do more of what's working. Okay, ladies and gentlemen, I will introduce myself in a moment. Let's get this party underway and started. If you don't know the protocol, what we do is we talk. Well, I talk and share ideas and thoughts on this topic. Today is structured scaling, about 45 minutes or so, and then we'll leave around 15 minutes for Q&A. If you'd like to ask me any questions, save them for then or stick them in the Q&A. There's a little Q&A section there that you're very welcome to add your questions as you go, and I'll get to them at the end. Okay, so today we are talking about, just double check, I think my microphone is good. I didn't actually check it. I'm getting complacent. Yeah, we're good. Okay, so any problems, feel free to ask me in the chat. Anyway, today we are in the Tactical Trader series of May, and today we're talking about structured scaling. So this is a huge topic, man, and I've tried to condense as much as I possibly can down into valuable ideas and thoughts and frameworks that are going to help you with your scaling. I don't think there's a one size fits all. I don't think, well, I don't know everything about this. And I know it's very much down to personal preference. So I'm going to cover a lot of ground today. I'll do my very best to kind of cover as much as possible, and you take the ideas that you think are relevant for you and your trading. Obviously, we've got a mixture of traders here. We've got day traders, we've got a few swing traders, we've got currency traders, we've got probably a lot of indices traders, or index traders, should I say. Different sides, different experiences. So, take what's valuable to you in your trading and run with it, and discard the stuff that's not. That's okay. Not everything I'm going to say will resonate with you. That's fine. So today we're talking about scaling in and out with purpose, not emotion. I try not to get ahead of myself here, but there's a great quote here from Paul Tudor Jones. Very kind of apt, I guess, for the current conditions. Where you want to be is always in control, never wishing, always trading, and always first and foremost protecting your butt. Paul Tudor Jones is one of the greatest traders alive. Now, really what he's saying here is we can only control the risk. That's the only thing, the only aspect of the trade that we can control is the risk, how much you're prepared to risk on the trade. So if you keep that under real strict lock and key, like, hey, I'm very disciplined, I'm very focused, I'm not risking more. It's very, very important that when we talk about scaling, or talk about scaling into a trade specifically, that's when the risk can get away with you if you're not careful. We'll definitely be touching on that today. But I want you to think about what Paul says here, which is, hey, you always want to be in control, never wishing, always trading, and first and foremost protecting your butt. So if you're adding to trades blindly, this is this kind of thing that can get you in trouble. We'll talk about that in a moment. Okay, so let me make sure I'm on the right thing here. There we are. There we go. We can get it right. I've only been doing this for how many months? We get it right. So, ladies and gents, welcome to this webinar. I know many of you have been here before. My name is Mark Holstead. I'll do this very, very quickly. I'm not here to tell you how to do things. I'm here to give you different ideas and different perspectives on trading, especially today's scaling. So I don't stand here or sit here and say, oh, this is exactly the way to do it. But I come from a perspective of, hey, I started trading in 2001. I also have seen many traders come through the developing phase and things work for them. I've seen many hundreds of traders who've fallen by the wayside and do stuff that hasn't worked for them. I study the great traders. I'm friends with some great traders. I have a good network of other traders who are developing, who are really excellent, who are way better than me, who are on the same level. So I'm come from a perspective of, hey, I want to share with you what I believe are the main valuable points that are going to help you in your trading. As I said earlier, I don't think that everything will apply to you, but your job is to take the things that you think are valuable and do your own research, your own analysis, your own homework, your own thoughts, and run with it and say, listen, I'm going to implement this slight change. We'll talk about scaling today. I'm going to talk about, I'm going to implement a little change in my scaling, and I'm going to run with it for a while, and I'm going to audit the performance after a couple of weeks and see if it has a positive impact, make some adjustments, keep moving forward. Why I say this every week is the biggest thing, the challenge with traders, and listen, I've been through the same journey as you, and made all the mistakes under the sun, right? This is the path of a trader, and you probably have too. But one of the things is you try and make a change, you're all geared up and fired up after a webinar or after listening to a podcast or after reading a book or whatever. It's going, yeah, I'm going to do that. You do it for one trade, doesn't work, and you go, I'm not going to do it anymore. I'm going to go back to my old ways, and you never make any progress. So if something I say today resonates with you, and I hope it does, I try my very best to distill a lot of information about scaling in this 45-50 minute webinar to help you. If it does resonate, grab it. Then your job is to take it and implement it into the way that you trade specifically, because I don't know how you trade, and you grab it and you go, yeah, I'm going to make that adjustment, I'm going to make that small tweak, this is the heading I'm going to go on, and then I'm going to audit my performance, see how that's affected my trades from my journal and my performance, and then I'm going to make a course correction and go on a new heading. So things take time. Implement that change and stick to it. And I say this kind of every week. If those of you come regularly, welcome back. If you're brand new to here, you're very welcome here. And I say it because I think that's how you get the most value out of not just this webinar, but anything else. There's so much content out there. A lot of it is good. There's a lot of rubbish. Okay, fine. There's a lot of good traders sharing valuable content, and even that can be so much noise. So your job is to distill down what you think is valuable for your trading, not take anything as gospel, just assume that these things are valuable, but only if you can run with them, make them work for you. First things first, or the last thing before we get started, should I say, please be aware if you are trading spread bets, CFD, in fact, any instrument with leverage, very high risk, guys. I know everyone talks about the upside and how great it can be, and yes, it can be very, very nice if you're on the right position with the right size and using leverage to your advantage. But you and I both know that if you get caught out on the wrong side of something, you're using leverage, things can get nasty very, very quickly. There's a pro, there's a con with trading on margin. So if you're trading CFD, if you're trading spread bet, please be really, really aware of how leverage affects your profit and loss. And we are hardwired, sadly, but that's why we kind of get rewarded well when we do it right. We're hardwired to kind of maybe hold on to trades a little bit longer than we should, maybe take more risk than we should. We deal with all that for emotions and sort of mindset, handling emotions. We can have good protocols for risk management. We can't eliminate the risk completely, but we can really dial down the negative impact of leverage as much as we can. And that is going back to first quote from Paul Tudor Jones, which was, hey, just make sure you're really, really aware of your risk. And it's very apt today with scaling, because sometimes I think for some people this might not be an option. Scaling in into trades, especially talking from a pyramiding perspective, is probably not going to be the right thing, depending on where you're on your trading journey. Anyway, I'm getting ahead of myself. Just be aware of the risks, guys, and understand what you're doing when you're trading on leverage and margin. Okay, so what we're going to cover today, we're going to plan our scaling decisions in advance. Lots of charts today, lots of kind of ideas and frameworks and ways to add them to your trading model, tactics for scaling in and scaling out. We're not going to be trading from an emotional perspective, which we never want to do anyway, and we're especially not going to be scaling in or out of a trade based on emotion. We'll talk about how we can kind of combat that and other ways to kind of avoid what I call this trade bloat. Well, you don't want to really push so much size and push all your chips in when the trade isn't ready to mature, or the trade is, sorry, should I say, is almost matured and it's almost hit the target. Because one of the biggest nemesis of traders who are scaling into a trade from a pyramiding perspective, we'll talk about all the four different variables in a moment, but that's the one thing that catches people out, pushing too many chips into the table and ruining what otherwise is a good trade. Okay, so let's just set the scene. Scaling, I know that you know what I talk about here from scaling, but let's just make sure everyone's on the same page. I know many of you are intermediate traders, developing traders, you've got some experience in the markets, but so that we know we're on the same page here. Scaling in, we've got these 4 different ways of scaling. So we've got scaling in as a trade goes in your favor. So that's okay. I bought at 100, I'm adding 101, 102, 103, 104. That's scaling as going in your favor. You're long and you're adding as it going in your favor. Something's called pyramiding. Scaling as a trade goes against you. So you're long at 100, you're long at 99, 98, 97. I'll tell you why I'm not a big fan of that in a moment, but that's one way of scaling in. So your scaling goes against you, scaling as goes for you. And then the other way is scaling out. So the trade goes in your favor. You're long from 100, you scale some out at 101, 102, 103, 104, 105. Or I won't really touch on this much today, but it's still valid. You're long at 100, and as it goes against you, take some out at 99, you take some out at 98, you take some out at 97. I'm not going to talk about that at all today, but it's still a valid way potentially of mitigating risk. Now, I'll talk about it for maybe 30 seconds or so. Most people go from operate from the perspective of, hey, here's my trade entry, here's my stop. I think that's the right way to do it myself. Some people might split the stop up into 2. And I think for certain setups, that's okay. You've got to have a really good reason for that. So let's say you're long at 100, you go, oh, my stop should really be here. So I'm going to put half of it here, half of it here. Or if it breaks this level, I'm going to peel off half and I'm going to see kind of how it goes. I'm not a huge fan of that, but it's valid. If you come up with a plan, I think anything that's planned is okay. But just so we know those 4 different definitions, if you like, of scaling, we're going to focus on the first 3 today. Okay, so I didn't need that. That was a chart example. I made the chart with my hands in the air. You guys don't need examples. I've got loads of more chart examples, annotated stuff to come up in a moment. Okay, so let's slow things down, Mark. I know I like scaling. I'm a big fan of scaling, and I'll share with you why in a moment. So scaling matters so much more than you think because it can ruin a trade. You may well have been in a trade you've taken. It was a great idea, a great thesis, set up. You added to it. You got stopped out, ruined the trade, and then it carried in your direction. Or maybe you've scaled out of a trade as it's going your way, and actually by the time it's hit your target, you've got such a small position, you've hardly made any money on the trade idea. And so this is scaling has the ability to make or break a trade, make or break a strategy, make or break a trader. And I think that it's something that isn't really studied enough. I read a comment many years ago that stuck with me. I don't know why, but it's from like a forum or bulletin board, probably 15, 20 years ago or something, early days of trading. And it said, scaling out is inferior behavior. And I thought, why is that? And I kind of read some of the comments and people were saying, well, if you've got a trade idea, shouldn't you, you should be sticking to your target, right? You shouldn't be doing anything between there and your target. And I sort of sat with me for a while and I thought about it. And actually, I don't think that's correct. In fact, I know it's not correct because the market changes, the trade changes, the dynamics of the trade change as it goes in your favor. If you're coming up to a key level and that's the level of your target and it starts to show that it's stalling, it starts to show that it's reversing and it's a few ticks away, you're risking all of that move to come back to your stop to get another few ticks. Now, I know there's no perfect answer to this, but that was a real thing that stuck in my mind. I said, okay, well, scaling does make sense sometimes, as does scaling in. So, I want you to be open-minded about scaling. If you don't deploy it already, think about ways you can deploy it. If you do deploy it, then maybe you could make some adjustments to how you scale in or scale out of your trades, because the market's ever changing, right? When you take the trade, the market's different after 5 minutes after you've taken the trade to when you take the trade. The pattern's different, the time of day is different, the levels it's hit are different. The trade changes as it goes in your favor or goes against you. And so why wouldn't you readjust and adapt? Now, we don't want to do it from an emotional perspective, more on that in a moment, but it's really such an important skill set to get right. I think if you master scaling, or do we ever master anything in trading? We don't, but if you can get a grip on scaling and make it work for you, it can transform maybe an average strategy into a really good strategy. And it can transform trading into something that, hey, I'm actually not that great, but when I really deploy capital in the areas that I'm good at, that's when things start to work well. So risk control is very, very good for. Maximizing winners is very, very good for. We never know it's a winner, of course, until after the fact, but there are clues that we can look at. And the one thing is it boosts mental resilience. I've got a whole slide on this in a moment, which is something that's so overlooked and people don't talk about it, but it's so, so, so important for traders. And obviously, if you mess it up, as I said, you just get you're overexposed to trades, you're ruining good trades. It just ends up ruining your potential as a trader. Okay, so this is important, this one. Scaling can be a real mind soother. And what do I mean by a mind soother? What a choice of words I've used there. I don't know why I've mind soother, soothing the mind. So what I mean by this is, listen, I'm a big believer, right, that there are many things that we do in trading that aren't mathematically or logically the correct thing to do. Okay, but we're human beings, and sometimes we have to help the mind feel comfortable and confident in what it's doing. Sometimes it's screaming at you to take profits. Sometimes it's screaming at you, you've got too much size. This is a game of mind, right? It's just a mindset game, an emotional game. You know it, I know it. We're not trading. We're not an algorithm. You're not a robot yet. Maybe AI will come in and we'll have a little robot on our shoulder and be like, hey, come and take this trade. Anyway, we are a discretionary trader. We are discretionary traders. And emotions, mindset, thinking, the little voice, whether you call it the chimp, whatever you call it, is influential to your trading. And so whilst we're talking about scaling today, it's okay to do something that makes you a better trader and helps you make better decisions, even though mathematically and logically it might not make sense. An example is, I don't want to get ahead of myself too much. An example is the market runs up to a key level. Your target is the next key level. You see it stalling at the key level. The little voice in your brain says, that's going to reverse there. That's a big level. The other voice says, no, I'm holding it to target. You have this kind of, and you're frustrated, and whatever you do, you feel like you make the wrong move. If you take the whole thing out and it goes in your favor, like, I knew I should have held it. If you don't, it reverses. You're like, I felt that it was reversing, and why didn't I do anything? And so that's an example of where scaling can soothe the brain. You feed the chimp a few pieces, a small clip of the position. There you go. Now, if it reverses, I got something out there. If it carries on, fine. And you kind of find that sweet spot. Now, you might argue, and a logical person and someone who really doesn't have any risk in the game, or has never taken any risk-based decisions, might say, well, it's not optimal. If your target is there, you should hold for target. And if you're a person who can do that, then fine. But many of us have these challenges where we have that little internal dialogue going on that's giving us doubt, that's making us second guess things. And so sometimes we have to, give a little bit so that we can become a better trader for it. If that means scaling a little piece off at a level that, maybe you hadn't planned it, but actually you're allowed to take off 25% whenever the level you think is hit is going to reverse, and that's just enough to calm that inner voice down to help you hold the trade to the final push, then that's fine. So just think about that. Sometimes you do stuff for a psychological benefit as opposed for an operational benefit or from an equity curve benefit. Example is, if you read Tom Hougaard's book, I think it might be up on my bookshelf behind me. There it is, just there. Adding can be like a powerful antidote to fear. So Tom Hougaard's book, Best Loser Wins, he talks about adding to his trade because he was open and said, hey, I always used to close trades early. I wanted to kind of combat the fear that I was going to give back profits. The one thing to do was the opposite and to kind of slam more size into the trade. I'm paraphrasing, go read his book, but that was like a mind soother for him, and it kind of helped both sides of the equation. Just what I spoke about, scaling can give you more comfort and confidence to hold. And listen, you're a human being, right? You are going to feel emotion. You are going to feel times when, and also it's not going to be linear. It's not going to be, static. It's going to be dynamic. Sometimes something will bother you. I've missed that trade. Why does it not normally bother me, but today it does? Or, hey, I got stopped out. I don't care today. Actually, the last 4 days it bothered you. It's never going to be static the way you feel about the market, just like your mood is not always static. And so, recognize that sometimes in trading, embrace this, embrace the fact that you make mistakes, embrace the fact that you do have that internal dialogue in your brain, and you have to work with what you are and who you are and what you've got. And if you have a little voice that says, hey, you know what? it feels like it's reversing there, and the other voice is saying you should hold it, then plan into your protocol that you scale a little bit out to soothe that inner voice. That's okay, because that can still work out to have a great trading strategy, a great trading model that's going to be effective. You don't need to be absolutely perfect everything, because trading isn't perfect. And if you try and force perfection onto the markets, you'll get smashed. We have people coming in who are, they're scientists, they're engineers, they're all these high kind of really precision type environments where it's either right or it's wrong, and the market does not tolerate that. It will not allow you to do that because your mind is very, very different. And so you think about some of the things that you go and think about your dialogue, think about how you talk about things, how you reason with your brain, your thoughts, and how they translate to actions, and how you can soothe sometimes those thoughts. As I sit there and fighting it and go, no, 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 you can sell 10% of your position, and he shuts up, and you can carry on holding it. I feel comfortable holding it now. And don't fall into the trap where all the so-called gurus are saying, yeah, but you must be strict and you must. It doesn't matter. You can still be holding 90% of the position and make a very handsome profit on the trade and have peeled 10% off early. Don't feel guilty for doing something that's seemingly inferior behavior. Now, obviously, if it's really impacting your P&L, then you need to adjust it. But sometimes you do stuff that's not perfect, but trading doesn't need to be. Okay, I think I ran on about that a little bit, but I'm a big believer that's an important. Okay, so mistake number one, scaling without a plan. Let's go back to the scaling kind of operational side of stuff. Hopefully that makes sense, that kind of mind soother. It doesn't just apply to scaling, by the way. So scaling without a plan. So this is the big mistake that people make. And hands up, this is something I would fall into the trap of adding to a trade. Before you know it, you've got way too much size. Your risk is so high because one little dip back and it pings you out. And same on the other side of the coin as well if you're scaling out. So FOMO, sometimes you're like, hey, I don't want to miss this move. This is the one I've been waiting for. I'm going to add more size into the trade. Hey, the trade's going in my favor. Let me add more size. This is the right one. Maybe you are scaling out of a trade because the emotion is, I'm worried about giving back profits. Now, having the mental soother in mind that it's okay for a certain degree to do stuff, but we don't want to be scaling the whole thing out. We want to find that middle ground where we're still making the money out of the trade idea, but ultimately being cool, being calm, able to hold the trades. So it creates a messy average, you get unclear risk, especially with scaling into a trade. So what we want to try to do, and I put little asterisks here because we want to map out, want to map out possible scaling zones before entry. Now, I live in the real world, right? I am in the trading trenches with you guys. It's okay in theory before the day to map out all these lovely levels that you're going to scale out the trade. But the market adjusts intraday, especially with day trade or swing trade, doesn't matter. It comes up with these new levels. It comes up with new candlestick patterns. Maybe there's a big bullish ignition bar. Maybe there's a bull flag, a bear flag. You can't map that out before the trade, but you can still plan it and say, hey, do you know what? I'm going to add one layer onto this trade, one clip, and let's say you start off with the position of 2 units, whatever those units are to you, and you say I'm going to add another 1 unit. So I'm going to have 50% of my position size on, but I want to see either a bull flag, I want to see a support level hold, I want to see a bounce off VWAP, I want to see, you have ideas. So maybe they're not levels as in price levels, but they're actual patterns that and love to, well, not love to trade, but have efficacy, and you can kind of frame them under their own framework of trade. So it's all very well saying, oh, it's levels or zones I'm going to scale in, and maybe that works for you. I know a trader who does that very religiously based on an R unit, so it goes in his favor. He'll add another, he'll add another, he'll add another. But he's trading purely on momentum. So that will work for him because his only trade idea is momentum off a level, expecting it to kind of continue to highs. And so if that's true and he's got a reasonably wide stop on it, that makes sense. But if you're a bit more discretionary, then you might not have zones, you might have patterns, you might have times of day and stuff. So be flexible. As long as you plan it, I'm okay with doing anything as long as it's planned. I'm okay with you doing anything as long as it's planned. So the second mistake is scaling into A to B trades. So many traders go, and I say many traders, I include myself in this years ago, it's like not differentiating between an A to B trade and a trade that actually could have legs and run further on to a higher target. I don't necessarily mean a trending trade, but I mean, the difference, right? Sometimes trades are it's a level to a level. It's going to go from here to here. I've got a chart example in a moment, and that's it. That's the idea. I think it's going to go from this level to this level most of the time in a range bound environment, right? Scaling in or out of that trade doesn't make any sense because, and nor should it be a mental soother, because if you're scaling into it, you're really limiting the amount you've got. Your risk reward is just so skewed as you start adding to the trade because your finite target is there. And so one thing to do is to really think about beforehand, is this an A to B trade that I'm just going to take the trade, one clip in, one clip out, done, and my stop is here. There's no management with it, there's no adjustment, there's no fancy business or funny business, versus actually, you know what, this could run all day. I don't know how far it's going to go, or a week, whatever time frame you're on. I'm going to allow myself a few entries on this, a few little extra adds to this, because this could really rip. There's two different things. Now, maybe you only focus on one or the other, that's fine. But if you're a trader who trades a bit more discretion, sometimes trades these A to B trades, then scaling shouldn't play a part in it at all. I'm not here to say, oh, you should scale everything. Absolutely not. Example, last week, if you were trading NASDAQ, maybe you're trading it via a spread bet or a CFD. If you're looking at the futures contract, you know that we're oscillating around that 20,000. 200 points up, 200 points down, 19.8, 20, 2200, 20. This is what we were doing. And so if you were in line with this, you were for argument's sake, you were trading this way, you were trading long at 19,800 as you see the ignition bar, there might only be 100 points left in it. And so you're not going to be adding to the trade because your exit is 20,000. Same if you were trading from the high side down, so that you were trading that exhaustion down to 20K. You're not looking to overstay your welcome. And so this could be for any market, by the way. I just picked this because this was from last week. But differentiating between an A to B trade and a trade that you'll potentially got more mileage on, that will indicate whether you're going to scale in or scale out the position, or even allow either one or the other, or both. Okay, so, and that's, by the way, that's why I'm pausing for a moment, is but that's important to really think about. Each trade has different dynamics to it, and it's very much dependent on the type of trader you are and how you like to trade. But not to overcomplicate things, and that's the last thing you want to do in the heat of the moment, is give yourself more complicated decisions to make. But sometimes it's putting into a category of, okay, this could run, this is an A to B trade. You're not always going to be perfect, but if you decide beforehand, it takes the burden of decision off your shoulders. I need to think about scaling, because I just think it's going to this target, either does or it doesn't. It's a risk reward ratio 2-to-1. I give it 50-50 chance of success. That's going to work out in the wash. I don't have to do anything. You click the button, you leave it. You don't have to manage it, you don't have to adjust it. I'm not doing anything with it. Versus trades that maybe have some more mileage. And I think why I kind of linger on this point is I think that it's something that is well worth looking into with your trading. Like, hey, do I have a trading model that's just level to level, A to B, versus trades that I don't quite know where they'll go, or maybe they've got a really big target and it's kind of extended move, and actually I need to look at them slightly differently through a different lens. And I think the danger is when we look at everything through the same lens and actually using the wrong skills or the wrong what's the word I'm looking for, techniques, let's say, for using broad techniques for all these type of trades, and actually they're distinctly different. Anyway, so some rules to think about when for scaling in with discipline. Definitely define your max size before you enter. It's so easy, especially if you're, in fact, both ways, right? If you're a day trader, especially. So if you're a day trader, it's too easy to get carried away in the heat of the moment, adding clip after clip after clip after clip. Before you know it, you've got way too much size. That can work whether you're scaling into positions going in your favor or going against you. I'm really not a fan of going against you. We'll talk about it, because I just think that it just encourages bad habits. If you think you want to get long at 100, you're adding a 99, 98. You're in your biggest. The problem with this is this: you're in your biggest position size when you're losing trades, and that just very rarely works out. Now you might be like, oh yeah, but Mark, I work a position in, and that sometimes goes in my favor. Okay, just okay. But you've got to be so strict and go, that's my initial entry. That's the last place I'm adding. I will add 3 clips between there and there, or I see some entries that I want. I'll stagger it and I'll play that just about acceptable, I think, just about. But you're still going to be in your biggest position on your losers, because you could have the full three, and sometimes you'll get one, you'll take one of your positions and jump off without you. So I'm never a big fan of that. I just think it really encourages bad habits. But you should, whatever you do, is define your max size. Whether you're scaling into a trade that is going against you and you're kind of averaging that entry price, or it's going in your favor and you're adding, because you get carried away with momentum, add more, momentum, add more, momentum, add more. And before you know it, you've bought the high, you're fully loaded up, your average entry has gone right up, it only takes a slight little rock back. So define your max size before you enter, and don't allow yourself to become a victim of emotion on the scales, just like you wouldn't do on the entry. And use things like structure, like levels, ATR, VGAP. And I'm a bit loath to kind of say, this is a really way you should be scaling and shouldn't be scaling, but you're sensible enough to know what a good level is, right? If the market kind of rallies off, pulls back, starts to base at a level, maybe wicks below and comes back up, and you're already long from the lows, then if you're going to add some, you plan to add some, that's probably a good place to add another lot. You add another clip there, you put your stop under that with that entry, or if you prefer to bundle it up and average it, that's fine. I don't think there's a right answer to that. It's up to you. But you know that makes much more sense than having kind of a fixed point. So think about that from a price action perspective, from a structure perspective. Where could I add to the trade that A, gives me the advantage of adding, i.e. adding extra profit on the profit potential on the trade if it goes my way, and B, it doesn't ruin the average entry of the trade and ruin the whole structure of the thing. So chart example before that, when to add and when not to. Price structure confirms, talked about that. Time of day support. If you're a day trader, you know very important the time of day, how it plays a part. European close, the open, coming up towards data, the afternoon session, the afternoon breakout, that type of thing. Trade is proving itself. And if you like trading volume, you look at the point is all the things that matter to you as a trader should apply in the scale as well. You treat it as hey, this is important, right? If I'm going to scale some more, allocate some more risk capital to this, it should tick all the boxes. Don't add to it just because you're sure it'll work. That's such a dangerous thing to do. Okay, so I've used this example on crude a couple of times throughout these slides. So let's say, and why I use it is I haven't got any kind of anchoring bias and stuff. I've not traded crude for a while. So this is a good kind of example of different things you can do right and do wrong. So let's imagine you were looking for crude to kind of push back up in a target of $60, right? Put a little line up there, $6 with the little magnet on it. Okay, so if you were scaling into the trade, let's say you bought your first entry at the first arrow on the breakout, great. Let's say you bought the second entry on the pullback to that breakout, the second arrow, and the third entry there. Now, at that point, you're kind of reasonably structured. Yeah, you've bought on the breakout as your initial entry. It's proved itself, broken out, pulled back, you've bought another, and then it's broken out again, and you've bought another. And your average entry isn't so bad, and eventually you kind of have to wait till the next day, but you've kind of got your target. You haven't got too crazy, you haven't chased stuff, you haven't really ruined your average entry position. You're in an okay, you've allowed the trade to mature, but you've now got three times the size, but you've now had 3 ads. By the way, you don't have to add, one unit, another unit, another unit. You can add a 50% or 10%. You can play around with the proportions that you add to the trade. But the point is, you don't want to ruin the whole thesis, because you can completely ruin a trade thesis by having too aggressive scaling, or just not really thinking about what you're doing properly. Example here is, I should have made that a little bit larger, the text, apologies, but this is the same trade, right? You buy there at your entry. Let's say you now get eager and you add another clip right into that high. You go, it's running enough, I need to add it. And then you add another one into that next high, that next swing high. All of a sudden, your average has become worked out at 58.29. By the way, I didn't reverse engineer it for that pullback. I just thought, where would you add if you were kind of panicking into it, going, it's going to run to 60 without me? Probably going to be near the highs of those last candles. That's just how the market works, right? And so you think, oh, it's great. I got this great entry down there, 57.71. I'm adding now here in the 58. Yeah, it's fine. But before you know it, if you added the same amount on each of those trades, your average has come right up to 58.29. In this example, you got pinged. And I promise you, I didn't reverse engineer that. I just went, well, if you added here, would it be pumped into a calculator? And look, because that's how the markets work. they stretch, they catch people out. That's why you get those kind of last bars. Everyone's panicking into the trade, whether it's a stop loss, whether it's a market order. That's what causes those last bars. And if you're one of the mugs, and I put myself in that category, you get sucked into that kind of price momentum late, even if you had a great initial entry, you mess up the whole dynamics of the trade. And so you compare that to the previous slide where you were more structured with it. Just be aware that adding to the trade sounds good in theory, and when it works, it's great. Previous slide, you've got 3 times the size on, great. You've got the average entry, it's moved up, but you've now got 3 times the size. Lovely trade, it's going to be very profitable for you. Versus this, your trade idea is still valid. You've been too aggressive with your adding to the position because you've got caught in the FOMO, or necessarily FOMO, you've got caught in the confirmation bias is probably better. This is going my way. I don't want to miss it. I want to make sure I'm fully sized into this. I want to make sure I'm getting paid for this job, blah, blah, blah. And you're not thinking about how that affects your average. And so in this example, the whole thing's ruined. And so be very, very mindful about adding to the trade that you don't ruin what is otherwise a good trade, because we all know what happens next. You get stopped out in that pullback. What do? It runs up to 59.50. You go, well, it's only 50 cents. I'll buy it and just scalp a quick 50 cents. It rocks back a buck. You get stopped out, frustrated. You think, oh, it's maybe a short, and you end up trading all sorts of stupid things. We've all been there and all done it. And ends up, not only does it kind of, you don't make the profit you should have done from the trade idea in the first place, you end up doing foolish things as a result of being triggered by getting stopped out because you're frustrated, you're annoyed, you think it's going your way, and it messes the whole thing up. So not only do you get the stop out from that trade, but actually you get the double whammy. And I'm not saying you necessarily have to stop or break even, but if you did, this is the result it would be. And it's to illustrate the fact that, when you're scaling into a trade, be very, very mindful. It's not a perfect science. Because you say, well, I'll scale on pullbacks, but there may be the move is over. So I can't give you a definite answer in the best practices, but all I can say to you is be very, very careful that you're not ruining what is otherwise a great trade idea, and that's your skill. Maybe you've got a great skill of spotting these moves and great having these good trade thesis, but you're screwing it up because you're adding to a trade, or screwing up because your stop's too tight. The actual other additional things that you bolt onto the trade are actually what's causing the damage as opposed to the trade idea. So now one thing I would say, I don't think I've covered this, is, listen, if you are a relatively new trader and you're kind of finding your feet, you're trying to find a method that works, you're trying to find the trading model that works for you, the methodology that works for you, then scaling maybe is something to leave to one side. By all means, note it down, say, hey, it's where I would have scaled, make notes, but you kind of want to just prove that your directional read is right first. So in that example there, you're long there, your stop goes there. Let me see if I can do that 10 times. Let me see how it works out after a 40 trade cycle, and then layer in scaling in, scaling out. I'll talk about scaling out in a moment, because that just adds a layer of complexity, and as you can see, can ruin otherwise good trades. So something to consider. Okay, so let's talk about scaling out now. By the way, I super recommend Tom's book for scaling in, because he talks, I think, doesn't necessarily talk about it from an operational perspective, but definitely from a mindset perspective. Okay, so the art of scaling out. So I like scaling out. So what? Some people go, oh, well, you scale. I really like scaling out of positions, because I find that it allows me to feel more comfortable with the trade. If I'm trading bigger size, right, I feel like, okay, it's exhausting, especially the current market, right? It runs up to a level, it feels like exhaustion. I have a good feeling that it's going to rotate back. So I always say to myself, well, why wouldn't I peel some off into that? Now, you can work around a core position, but I think it's okay to scale out. Now, listen, if it's just the start of a move and you think there's so much more to go, then you sit on your hands. You go, no, what? I'm not touching this. I'm going to leave this for 15 minutes, 20 minutes, an hour to mature before I even consider managing it. But I think this can play a really important part in your trading. So it can reduce risk exposure. And like I said before, as the trade develops and matures, as it's coming up to your level, then if it starts to top out, why would you kind of hold the dynamics of the trade changes? All of a sudden you're risking 10 to get 1, because now you're moving up. Now it's not a perfect formula, that, But if you started off by saying, let's say at a 10 to 1, right? You're risking 1 to make 10. As it comes up, you've now got all that risk. Now, do you move the stop? That's one way of managing that. Do you take some of the trade off? That's one way of managing that. You just have to adjust and adapt. Now, you have to be careful you're not operating from a place of fear. That's one thing. That's probably a separate topic. But if you're doing it from an operation, you think it's the correct thing to do operationally, there's nothing wrong with taking some profits off the table. Lock some profits in. Say, you know what? That I think that's likely the trade is done. I want to take some for that. I want to pay myself for being right, and then I want to see what happens. And by the way, I want to tell you a little story about a trader who may well be listening. If you're listening, pal, you know who you are. They were very, very good at spotting initial momentum bursts, so initial reversals intraday. Spotting that, I'd say 90% of the time, but a lot of the time they would get that first pop. So a few minutes pop, very good at reading that kind of price action shift, supply demand shift, the tape shift. But then after that, it kind of became a little bit, 50-50 maybe even less, right? Sometimes it went on to their target, sometimes it stopped them back. This came out and stopped them back, should I say. This was frustrating them. And so what I said to them is, hey, why don't you just cash flow the trade? Just cash flow the thing, right? So in other words, it pops in your favor, take some off, pay yourself for being right there. And then the other trade is like, I hate using the word a free trade because it's not, but you kind of put yourself in a position of power there where you've used your advantage of being able to spot their very, very quick momentum. You've taken a chunk of the profits to pay yourself for that read, and now you're able to treat the new trade completely differently. Like, hey, it's not so much skin in the game. You're not completely all in on that. You've leveraged on your ability to read that momentum shift. You've paid yourself for that, and now you're in this bigger trade. And so sometimes it can become part of a bigger operational plan of, hey, I'm going to work to my strengths, and my strengths are the ability to spot this pop. So I'm going to scale out into that to leverage myself into a position where actually I'm okay at these, but these are a bit more hit and miss. But I put myself in a position of power that even if the 50% of these go my way, or even if all of them come back and stop me out, I'm still profitable. And so then you go, and this is why I think scaling is important, because you play to your strengths. Like if you're very good at spotting that pullback and the pop back to highs, then peel some off. If you're not so good at holding them for multiple pullbacks, and you're not so good at reading when the market's turning on a broader basis or a higher time frame, then play to your advantages and say, well, I'm going to be more aggressive with my trading and more active with it. All the other way around, that's fine. But like I say at the beginning, there's not a one size fits all. And also, the conditions change, right? If you kind of trading a market, everything else that's correlated starts to roll back. You're looking at that. You see your market turn. It's a little bit away from your highs. You go, you know what? I don't want to have all this risk capital on this trade still. And as long as you're not thinking, I don't want to give profits back for the sake of not wanting giving profits back, you think genuinely the trade is done and it's part of your plan, I think it's fine to scale out. Now, I know I'm saying a lot of this, but you don't want to be in a position where you're using scaling out as a crutch and as an excuse for poor trading. It's very easy to say, oh, I'm scaling out into strength. It's a bit of a cop out if you're doing it just because you don't want to hold the full position. You and I both know the difference. You know the difference between scaling out at a structured level that you believe is a reversal point, and actually you want to take some capital off, you want to de-risk the trade a little bit. It's a commercial decision versus I don't want to give this profit back, I'm trading too much size, all of this stuff, and actually it becomes then a kind of chimp-based decision. I use that from the chimp paradox. It becomes that little inner voice that's trading out of fear. You know the difference, and so we've got to be careful that we don't use something as an excuse for stuff that's not going to serve us in the future. If you think about kind of the visualizing the trader you're becoming over the next years, how are they trading? Are they kind of scaling out every little bit? They're probably not. They're probably proactively scaling when they believe the market's going to turn against them. Now, they may not be right, but it's more of a considered commercial decision as opposed to, well, it's just moved up a little bit. I'll take another bit of money. I'll take another bit of money. There's a distinct difference. And so you've got to make sure that you're aligning yourself with the correct pathway there. Okay, so, I've skipped on a little bit much here. So how to structure a kind of exit plan. I say how to, you take this with a grain of salt, adjust it, adapt it. One way to kind of exit when you're scaling out of a trade, or a good starting point, because you might be like, Mark, where do I scale out? How do I even start this? You might say, you know what, I'm going to start off by taking a third of my position out at 1R. So that kind of takes a little bit of risk off the table. I'm going to take a third off at key level that I have aligned or I see developing, and I'm going to hold a third. Now, there's multiple permutations of this, multiple, and I don't think anything is right or wrong, but it's a way to start off. And the thing is, like all trading, guys, you want to really shine a light on what you're good at. And sometimes that's either eliminating things like having a wider stop that allows you to see if it's your actual trade idea that's wrong or your stop is too tight. You hold it for a certain period of time. There's certain things that really allow you to prove yourself as a trader and show your advantages and shine a light on your weaknesses. And so one way to do this, if you did this and say, I'm going to take a third off at 1R, in other words, your risk. So if you've got 50 cents risk, you take off 50 cents when it moves your way. If you find that the majority of your trades go to 1R in reverse, if you weren't using this, you'd be like, keep getting stopped. Unless you were tracking your maximum favorable excursion, you wouldn't know that actually maybe you've just got a good feel for that first 5-minute pulse or that first 15-minute pulse. After that, you don't really have a good read. That's okay. That still could be a profitable trading strategy. You just are using the wrong tool for the job. You're trying to hold that for the full day move. And so structured scaling plan can really prove to you what you're good at and what you're not so good at and what needs work. If you're catching that 1R and you're getting out the key level and the runner doesn't hardly ever goes your way, then maybe you adjust and adapt and you say, you know what, I'm not going to take out a 1R. I'm going to take 2/3 of the position off or all of it off the first key level I see it store because that's what I'm good at. Or you see, hey, most of these trades are running really, really strongly. Well, in that case, don't do any scaling. Like try and hold the trade for as long as you possibly can because you've got edge in being able to spot a trade that's running on. So again, very personal, but scaling, having a plan of action and how you're going to scale can really, really help. And that's scaling in or scaling out. You can do the same thing. I'm going to scale in. I'm going to see if I'm really good at kind of spotting that early move, or actually I'm actually quite good at getting the bigger drive, but I'm ruining it because I'm scaling out. I should be adding. It's really difficult to kind of pinpoint exactly what's right for you, but if you put some work into it and think about it, you can really find a solution. Another thing to consider is a time-based exit. So something I'm a huge fan of is using some sort of time-based stop or exit. Whether that is a duration of time, because yourself, the market you trade dollar yen, you trade cable, you trade Nasdaq. The cycles it runs in. It might run for 15 minutes. It runs for an hour. It runs from this time to this time. There's a rhythm. There's a structure to it, and so you might say, hey, I'm going to hold this until the kind of noon chop. I'm going to hold this until the volume declines. You trade in the US markets around now when we kind of get a little volume decline. Today's a little bit different, fine. But and then we get a pickup in volume towards the end of the day. You might say, hey, I'm going to hold it and I'm going to remanage it and be active and kind of move the stop up a little bit more, or I'm going to peel some out, or I'm going to hold it for a fixed number of bars. I want to let the trade mature before I even think about scaling in or scaling out of the trade. And so you don't forget that big component of time is so, so important. It's not just the price-based game we're in. That's what matters. That's why we're judged. But you and I both know that the time plays such a key role in how price moves. And so think about how you can implement that into your kind of your scaling plan, your exit plan or entry, etc. Let's use that example. If we go back to the crude oil example, this was zoomed in a little bit more on a 5-minute chart as we're coming out to that 60. Remember the trade idea that we kind of had from a hypothetical perspective was, hey, we're going to look for the run up. The magnets are $60. Let's see as it comes up. So scaling out, you might say, I'm going to have some out of 60. I'm going to scale out into new highs. I'm going to close the 5-minute bar. And so you got another one, and then maybe you leave the runner and you pull that a little bit, have that a little bit loose and say, if it breaks below that kind of structured low at 59.85, whatever it was, I'm out. So you can play that game where you have two choices. You either say, I'm going to sell into, if you're long, I'm going to sell into strength, or I'm going to let the trade take me out. Again, it depends on the structure of the trade you're taking. Now, this is the way I like to do it, and I don't say I'm right or wrong with this, but as we're coming to the level that I think is the final target, I will sell my position into strength, because if I believe that's a target, I don't want it to come back. Now, if, however, you don't know how long the trade is going to run for, you need to give it a little bit of room. and I know Peter, friend of mine, great trader, will let the trade take him out by moving his position up. He will move his stop up, move his stop up, move his stop up, and trail. Now, I don't know whether he splits his position up in scales or not, but you've got to make that decision, right? Do you sell into strength and try and get a good price, or do you let the market tell you when to come out? And some people sit really like angry on one side or the other. I think it depends on the trade you take. Some trades coming into a level, hey, I know there's liquidity there. I know stops are getting pinged. I know there's urgency. I want to be on the other side of that. I want to take advantage of that and get the best possible price versus, hey, this is a grinding trend day. I don't know where it's going to go. There is no spikes. So I will ratchet my stop up and let this kind of thing tell me when to come out. And so from a scaling perspective, you can split that up into multiple chunks and say, do I scale some out aggressively, or do I scale some out into strength, or do I trail some? What's the proportion of mix? Do I do half here? Do I do half there? It's a commercial decision that you base on the trade you're in and the environment you're in. Okay, so one thing I wanted to really kind of talk about finally here is this three-layered entry model. So one way of exploring scaling, and I've seen this work for some traders, is you use an initial small size entry. Many traders like to have what we call a feeler position. Now, we might do a whole webinar on this, but to get a kind of feel for the market, it's very common in the pits. The guys in the pit would put a position on to get a feel for, it was slightly different then, but how quickly the order would be filled, what price they'd get, this type of stuff. And if you read Jesse Livermore, Reminiscence of a Stock Operator, he talked a lot. I know it's very different now. I understand the execution's a lot different, but he would say I would often put a piece out to see how it was filled and get a feel for the market. Now, he was looking from a perspective of I got filled at my price straight away, then maybe I didn't want it because there's a lot of pressure there. That doesn't apply for us now in the current electronic markets, but sometimes with some skin in the game, you feel the market better. Maybe you're that type of trader, right? You get a position and all of a sudden you're a bit more focused, you're a bit more tuned in. And so one thing you can do is take an initial small size entry around the level you want to get in at, then with an idea of timing that primary core position, the bigger position, the piece that you want, a little bit better because now you're a bit more in tune, you're a bit more focused. You add that clip, and then you add one more chunk as it's going in your favor. So you add the probe entry, the small position, just to get in, just get a feel for it. Obviously, manage the risk on that. That's a very low risk from a financial perspective relative to what you're risking on a broad nature. Then as it starts to, you find the level, you go, there's my position. You add the full position. You put your stop in, you do all the risk management, and then when it's going in your favor, you add another little piece, another little clip onto the trade to kind of ride the momentum. Obviously, depending on the trade structure and whether it's an A to B trade versus a trade you think is going to run. That's a very simple way of getting good at adding to trades, getting good at kind of gauging trades. One caveat to this is if you're not. Don't do this if you've got a lack of discipline, right? If you're disciplined, like I'm adding to trade losers, I don't want anyone to fall into that trap because I think that's deadly. But if you're a trader who finds themselves more in tune, more in focus, and reads the market better when they've got something in the position, in something in the market, use it to your advantage. Put a small entry in, take a trade, put the rest of it in, add. It's a very simple 3-step process, but it gives you allows you to develop all those skills. And also, again, it shines a light on what you're good at. Hey, I'm really good at spotting the entry. And if it costs me a very small position size to be able to tune myself into the bigger entry, and so be it. Right? You just work with that. You work with who you are as a trader. And the same with momentum add. You add a small bit, and if you say, actually, I'm really good at that, then you increase the size that you add on that momentum. And so this is a really good way of kind of really deciding how to trade this. So example on this crude oil would be you added on the first probe, their little probe on the pullback to VWAP. Let's say it's a little bit more of a riskier position. You're like, then as it went in your favor, you're like, actually, you know what? That's probably the full position now. I feel more in tune. Let me go entry 2. Then you add a third one on that momentum and come out at your $60 level. Okay. One thing I wanted to mention is this concept of trade bloat. And I repeat myself a little bit here, but just remember that you don't want to overburden yourself with decisions in the heat of the moment. It's already damn hard enough as it is to be looking at the charts, going, should I hold this trade? Should I cut the trade? You're now adding another layer of decisions. Should I add the trade? Should I scale out the trade? you end up doing nothing right. You end up trying to spread yourself too thin. You've got a finite amount of focus, and so be very careful that you limit your decisions. You only want a couple of decisions per trade max. My entry, my stop. Do I want an add to it? One add, and that should be pre-planned anyway. You're just making a decision of what level area ish do I add, and even something I like to do is kind of the trade ID. I've got the target up here. I've got my entry down here, or my, I've got a level where I won't want to add any more. That stops you adding more into the trade. That ends up ruining the risk reward ratio of the trade. So I put a kind of opaque red box. If I'm planning on adding to the trade, that is, like it says, hey, there's no ads here. Once it gets to that point, you don't touch it. You let it run and you kind of manage it accordingly. But up to here, you're okay to add, because if you start to add in the highs here, it ruins the structure of the trade. And so that's one way of, it's a bit clinical, but it's one way of kind of making sure that you aren't overdoing things, not adding to trades and ruining the risk reward structure. And also, listen, if scaling in or scaling out of a trade doesn't appeal to you, then don't do it. It's fine not to do it, but it's a good way of, the thing is, if you focus on one of these and you say, hey, you know what, I'm going to scale in or I'm going to scale out of a trade, I'm going to try and get good at that, then, that, again, anything with trading is if you focus your energy on one thing at a time and get good at it, then the next thing, then the next thing, it's too easy to spread yourself too thin. Okay, so emotional scaling, the silent killer. I mentioned this at the beginning, and I want to mention it again at the end here, is that, be very careful that you're not adding out of frustration or fear. Frustration of I've not got enough size on, I need to add to the trade, I'm scared of losing I'm going to scale out my position because I'm worried about it going against me. I understand that we're human beings and we're emotions, right? We have emotions, and I'm never saying that we don't and we should, that's the way it is. But just recognize when that little voice is telling you to scale in or scale out because it's, I don't want to miss this trade, I want to get a full size clip on, or I'm worried about losing that unrealized P&L. Distinct difference in voice versus, hey, I think this is topping out now. It's about the right time of day. We've seen a good run. Let me peel 50% off. Yeah, I'm happy to do that. Click. Much more considered rather than, oh, guys, running back out of the red candles. Oh yeah, and there's a difference. And so one of the real kind of key skill sets of a trader is to acknowledge the difference of the internal dialogue. Is it frustration, fear, or is it a calm, considered, logical decision? And premature exits, cutting winners early because it feels too high. Just be careful with that. The markets can go on and on and on, but way, way more than we ever think. And if that's part of your plan, then stick to your plan. And the main thing is sticking to the plan. And as I said at the beginning, it's like, if you decide how you're going to manage the trade, are you going to scale into the trade? Are you going to scale out of the trade? And don't deviate from that in the heat of the moment, then you're fine. You just get good at something and decide whether it's worth improving or whether it's worth binning off. And also something to do is just kind of track why you're scaling. Okay, so we talked about planning entries and exits, thinking in terms of these layers, like, okay, here's my level. I don't want to go in past this level. I want to be more strategic about the way I do things. I'm not scaling from emotion. It can ruin an otherwise good trade. You might have a fantastic strategy, a fantastic setup, good methodology, good trading model, but ultimately you're ruining it because you're scaling out too soon, and the numbers aren't working out because you're actually you're not letting the trade mature, so it's not giving you the full bang for the buck, or you're adding to the trade and it's stopping you out. So you can ruin a great strategy, but you can also amplify a strategy as well. And so it's your job as a trader, I know it's difficult, but this is trading, right? It's your job as a trader to work out where that fits in. Do I need to be more aggressive here? Do I need to be kind of more defensive here? When do I play defense? When do I go on the attack? How do I deploy the two? And you're never going to get it perfectly right, but if you can just make those slight adjustments, some of the trades you take and the way you approach things, you can put yourself in a much more calm way of trading, can be more peaceful, make more money when things are going your way, and being flexible, but being in control of how you're deploying your capital. Okay, so some things you can consider if you like this idea and you want to kind of take it home with you and kind of do it yourself. Think about a scaling plan for your next batch of trades, like scaling into the trade, i.e. adding as going in your favor, or scaling out of the trade. and thinking in your mind, like, okay, what would really reinforce what I'm good at, or what would kind of steer me away from what I'm not so good at, or kind of, because there's some things you're good at and not so good at. What would help you become better? What would really amplify what you're good at? And have you got a default way of doing things? You maybe start off with one scale. So like I want to really add to my winners here, but I find it hard because mentally, I feel like I can ruin things. Well, add 10%, add a very small slither. Just get used to adding something and start to log where that add is and how that affects things. And 10% is not going to do hardly anything to the position average. But if you want to get good at that, that's how you kind of start the ball rolling. Same with scaling out. If you scale out too much, which is one thing, then say to yourself, okay, I'll scale out. I'll only allow myself two scale outs and they can only be 10% or whatever it is. Again, you can do so many adjustments here, but your job is to, as a trader, as an entrepreneur, is to solve for X. Hey, this is my problem. This is what I'm trying to fix. How can scaling help me solve that? I want to make more from my best trades. Okay, I can hold them longer. I can have more size at the beginning, or I can add to the trade as it goes my way. Let me try adding the trade. Okay, how can I do that? You reverse engineer, you go back, look at your best trades. Where's the add point? Oh, you know what? I'm not holding my trades to target. I'm scaling out too soon, or I'm not scaling out too much. I let them come back. Whatever it might be, solve for X. Run with it for a bit, journal your trades, get a batch of trades under your belt, and then audit the performance, adjust, adapt, course correct. And that's the same with anything in trading, guys. There isn't any, there's no perfect pathway. It's trying something for a decent period of time to get some data on it of how you feel and your performance. And then you make an adjustment, you do it again, you make an adjustment, you do it again. And that's how you kind of move forward and find out your perfect trading strategy. And by perfect, I don't mean perfect for me to make every trade a win. Of course not. This is the real world. But perfect for how you feel in your trading, the confidence it gives you, the ability you have, and the comfort you have when you take the trade. You're comfortable with risk. You're comfortable with increasing size. There's little adjustments. Try something, move forward, adjust. Try something, move forward, adjust. Take notes. Rather than the scattergun approach. So there's lots of stuff here with scaling, scaling, and scaling out. Pick one if it kind of inspires you a little bit, and say, you know what, on that type of trade, maybe I could make more money from that trade. Yeah, I'm going to try doing that. Well, actually, you know what, I struggle to hold my positions to target. Maybe I allow myself to scale out 25%, just so I feel more comfortable, mental soother. And over time, you might find you don't need that because actually the logic, you might do that for a while, and you go, hang on a second, why am I doing that? It's actually ruining my P&L. And so then when you come to the trade again, you feel the urge to scale out. You go, no, listen, the last 30 trades I did that, most of them would have gone my way and I would have made more money, so I don't need to scale. So it's that approach of refine, adjust, adapt, audit, and just treat this like as a marathon. Hey, I'm just trying to get better, a little bit at a time, a little bit at a time, a little bit at a time. All right, so quick Q&A, guys. We've got some questions coming in. Thank you so much. I hope that's been some value to you. I know we've covered a lot of ground today. By the way, if you haven't signed up for my daily email, you can do so at tradersmastermind.com. I send that out every day. Okay. Thank you, Gary. Credible topic, so important. I agree that scaling out of winners is perfectly reasonable. Does not need to be a binary decision. Yep. You know what, Gary? Some people stand on this kind of hill. Oh, you shouldn't be scaling out. It's like, okay, fine. If you're doing it because you're scared of giving back profits, I agree. But a considered commercial decision to take some risk off the table, there's nothing wrong with that. As long as it's a considered decision. Now, you might not always get it right, but again, trading there's no black. It's not always black and white trading. Okay, Dante says, scaling into trades that goes against you is more suitable for long-term investing. Agreed. 401ks and so on with low or no leverage. Scaling into trades is a powerful strategy, but obviously things can go south fast, especially with leverage. I do agree. Yeah, if you are, you're long-term investing, you don't really care what the trade does, though. What the market does. You're like, hey, I'm holding this for X amount of years. Fine, your dollar cost averaging, you're adding into the trade. You go, hey, this is quite a good place. I want to get involved in this. That's completely different. But when you're trading with margin, with leverage, as you quite rightly said, things can get nasty quickly. And what I see is that you're in your biggest position on your worst trades. Because if you're adding, then logical says when it stops you out, you're going to be in this massive position. Now you might get away with it. It kind of comes around and rocks back. You go, oh yeah, I just need to add, and that's fine. But then the one time or a couple of times you get hammered for way more than what you make. So I think it's generally a bad habit, but I do think you're correct with the long term investing perspective. Arta says, hi, I missed half an hour of this presentation. Can I please have a playback link? Yeah, you'll get one sent to you, pal. If you don't, just reply to one of my daily emails and I'll make sure I send it to you. Although Pepperstone have got a system in place to send these out, recordings out to anyone who's registered. So you should get that. Thank you for joining me, buddy. Nuno says, thanks, Mark. Always great to hear your thoughts on trading. Appreciate that, buddy. I never got hold of that concept. Maybe my personality, but why add when you can be fully in from the beginning? Valid. I'm patiently waiting for my setup, so I'm all in. The way I see it, I'm getting a better price. I've come to the conclusion that trading my stops is best for me. Sometimes I will look for price levels, market conditions, sentiment, or price action will dictate that. What are your thoughts on this? Thanks. Nuno, I would say to you, mate, if you can get the full clip on right at the beginning, then that's perfect. Because like you say, that's the most efficient way of doing things. And if it works for you, you just stick to what's working. Don't even pollute your mind with any of this adding stuff. The difference, I think, when adding is that you might say, hey, the trade has started to go in my favor now. I want to add more incremental size into the position to make more out of the position. Maybe the position's changed and looks even better, because from a price action perspective, it might be kind of holding a lows. You're like, yeah, I'll take that. And as it starts to really run momentum, that's a momentum trade now, you add to it. So, there's reasons for it. But ultimately, like you say, if you can get the full size position or feel comfortable with it where it is, then that's great. And that's absolutely great. And you see your trade will stop best for you. Again, you know what? This is really good. I'm glad you put this question up because it's so personal. Some people love to just trail as market take them out. I don't know where the market's going to go. I'll trail my stop. Others say, hey, I want to sell into strength. I want to trade to a target. And this is why it's such a personal endeavor trading. You do what you're comfortable with. And the trick and the secret is to make that work and not get deviated. Like, I feel comfortable doing that. Maybe you don't get the results you quite want. You go, I feel okay doing that. So I'm going to find a method that I feel comfortable in and confident in that actually has efficacy and works as well. That's the key there. So I'm glad you said that because you feel like that's more comfortable for you. And the same for anyone listening to this or anyone kind of making a comment. Hey, I do it this way. I like that. Maybe it's not quite getting the results you want, but you stay focused on that because that's if you can get a full clip on right at the beginning, then great. Okay. Let me say, watching from Kenya. How you doing, pal? That's way over there. Over there. I use a trading stop so no emotion is involved. Great, James. Thinking out loud, surely when scaling into a trade, wouldn't it make some more sense from a comfort point of view to move the stop loss of the first trade and so on and so forth? The stop loss of the first trade. Yeah, you know what, Sandeep? That's very valid. You can either treat in each trade individually and say, hey, that's a scalp trade. I'm kind of adding at highs and it's a flag and I'm going to kind of adjust it and have your core position with the initial stop. Or you group them all into one. But regardless of how you do that, you kind of you still got the whole risk has still got to be calculated. Like, okay, well, that's R unit of risk, that's an R unit of risk, that's an R, even if your stops are slightly different. So, yeah, so, scaling into a trade. So I think actually, no, I think what you're asking here is rather than adding to the trade, do I just remove the stop loss? Yes, fine. I think that's great. However, I think you might know, you've probably been in a trade, Sandeep, where it's gone in your favor and dynamics just shift, right? Maybe you've got like an example I use, you've got a kind of bottoming pattern, it's moved off the lows, it's started to flag a bit, that looks good, and the target's still up high, so you feel comfortable taking another trade within the same idea. Now, maybe you had the whole position on the beginning, that's great, but maybe you didn't. You're like, I'm still prepared to risk more because you don't know how high it's going to go. And so even though it kind of seems uncomfortable, sometimes it's the thing to really maximize the best trades, and it's tough to do, and most people don't do it. And actually, Tom Hugard says in his book, most people don't do it, and most people get the results as we see. And so he's kind of an advocate for it. He's kind of way more aggressive than I, but he's an advocate for adding to the position, adding, because he thinks, hey, when I'm on momentum, I want to milk it for every single penny it's got, and using that to his advantage. Now, fine, you can play a different game, and you go, hey, I'm going to play defensive. I'm going to move my stop. I'm going to feel relaxed, feel comfortable. I'm really calm in my position. I just want to manage what I've got. That's one thing. Versus, hey, I want to be super aggressive and milk this for all it's worth and take the consequences of it going against me. That's fine, double-edged sword. But that one, if that works out, you might make 4 or 5 times the money than that person. But if you get it wrong, of course, you're out the game. So it's kind of one of those things where there's no perfect answer to it. But if it's something that fits in with your type of style, then maybe it's worth looking at. That's a good question. That's a good. It wasn't a question. I was just thinking out loud. It's a very good thought. Okay, James says, I saw 4 positions that met my rules but could not decide which to take. In the end, I did not take any of them, afraid of overtrading. How do you handle this situation? I'm a swing trader. James, good question. If they matched your rules, then you would take the trade. You say here that you did not trade any of them afraid of overtrading. Now, you perhaps should define overtrading versus a trade that matches your rules. If it matches your rules, you take the trade. Now, if you've got a finite amount of trades you're allowed to take in the day or the week, swing trader, so the week, let's say, then you don't take it because the plan says, hey, I'm only allowed to take 5 trades this month, week, whatever you are. And so this is the 6th, I'm not taking it. But if it matches your rules, then you should take it. Now, that's a very simplistic answer given. Let's go another level deeper. There may be a disconnect with how effective you think the strategy is and how confident you are in the strategy. If you're worried about taking it from over trading, then maybe revisit the trade idea and the rules and say to yourself, do I really like that? And be confident and comfortable with it. And if you are still, you say, okay, I like that. I would take those trades. However, in the heat of the moment, I'm kind of second guessing things. I'm saying about over trading. Here's what I'm going to do. The next 10 trades, I'm going to forget about anything else. I'm going to take the trade when I see that setup. It's going to be very strict. I'm going to take it. Here's my risk unit, etc. I'm just going to take it without question. And often that will really kind of weed out the reasons why you're not taking it. Because you say over trading, maybe it's something else hidden in there. But what you'll do is if you kind of season yourself to taking the trade when you see the rule or when you see the trigger, what that does is then that makes you become much more hardened to that little voice that says, oh, it might not work, maybe you're taking too many trades. No, that doesn't matter. I don't care the outcome of the trade. I don't care how many trades I take. I'm taking 10 trades that match this rule criteria. Simple as that. You do that, and then you see the outcome. And over time, you go, okay, maybe I need to tighten the rules up a bit because I feel like I'm taking too many trades, or I need to loosen the rules up a little bit because I'm not taking enough trades. And that's something you can do based on conditions, and it's kind of a dynamic judgment call. But that's one way to get over that thinking of, setting up, but I'm kind of don't know whether to take it or not. So be more strict with when and where you do take a trade. Sandeep, first entry stop loss equals second entry stop loss. Oh yes, okay, talking about when you're scaling the thing up. Yep, good. Ezadine says, hey, how you doing, buddy? Says, thanks, Mark, great webinar. Appreciate that, mate. Sandeep says, thanks for the presentation, really appreciate it. Very much appreciated, Sandeep. And Victor, much appreciated. Unreal value, appreciate that too, Victor. Okay, any more questions here? Leo Connor, how you doing, Lee? 1R equals first resistance level. No, 1R, so 1R will be your stop, right? So if you've got a 50-cent stop, 50 pip stop, 1R is one risk unit. So, as it goes your favor, 50 pips, you've got 50 pip stop, you take peel a bit off. That's so that you feel like, okay, well, it's kind of a simple way of structuring it. I'm not a huge fan of that, but if you were starting that 3 rule approach, that's one way of doing stuff. Now, obviously, you can get to a position where there's a massive key level there and your first exit is there. You kind of have to accept that and adjust it to suit. But 1 hour is kind of okay. It's going in my favor. Actually, if you listen to a podcast I did, you guys may have listened to this with Rushir. Rushir is, I think they've called it from part-time to full-time trader or something. He's made the leap to kind of full-time trader this beginning of this year, doing really, really well. He's very structured with stuff. He will add to a trade. It goes his way. His entry's very, he's got some rules for it. He's got a little bit of discretion, but the way he adds is super aggressive. But he will add on a fixed R unit. He'll add 2 extra times to get 3 times his position in, tighten his stop up, and then a lot of them will come back and ping him out like half an hour because he moves his stop. But when he's right, he'll make 6R on the trade. Beth says, "What a great topic. Thank you." Nuno says, "Thank you." Boris says, "Are you a happy person?" Very happy, Boris. Thank you. I do not come across happy. I feel like I'm yeah. Thank you for asking, Boris. I don't know if you're trolling me or you're genuinely asking about my happiness. David says, "When scaling in, when you use a 15-5-1 time frame, are you scaling at 5-minute levels or adding at 5-minute break flags and 1-minute execution?" Okay, so you're saying, okay, use a top-down approach of a 15-5-1. Are you scaling on the 5-minute or adding at 5-minute flag breaks with 1-minute execution? The latter. Personal, again, right or wrong here. I will have my thesis on the higher time frame and then use the lower time frame to confirm. And so, if I'm fine tuning, let's say I have that flag, I'll probably look for a little person. I like a little dip below the flag, range break, fake pops back up. I can see it easier on a 1 minute. Now, if you're watching price, you still see it on a 5, but I think using that lower time frame helps with execution. The only caveat I'll say to that is that you don't want to. Sometimes the lower time frame can show you things that aren't there. So I think you've got the right approach there. It seems like you look at the higher time frames for your methodology and your approach to things, and then the lower time frames to actually fine tune the execution. I think stick with whatever you're doing with that. Okay. Oh, missed this extra bit. Or scaling only at 15-minute levels. You know what? It also depends on what the thesis of the trade is. If you've got a broad idea, then maybe you want to slow things down. The way that I like higher time frames is it makes you just slow things down. If you find yourself getting sucked into like spiky candles and this, that, the other, then just calm things down and go up a time frame or down a time frame, whichever you look at it, 5-minute, 15-minute. It just helps calm things down. Yeah, you might not get the perfect entry, but if you've got a broader idea that's going to run on for kind of a few hours anyway, then there's no problem with kind of doing that. Nuno says Tom is aggressive. Yeah, I believe he is. Amini, I think I've pronounced that correctly. I've got a thumbs up there. Hi, Mark. Thank you a lot for everything over so many years. I've sent a message in LinkedIn to Traders Mastermind. Please check it out later. Thank you, Amini. By the way, if you want to, could you send it, if you reply to any of the daily emails I send out, if you reply to that, I'm going to deal with my inbox. We'll make sure it gets to me. Just put a reply in there and I will read that reply and reply if I can help you. I don't think we monitored the LinkedIn box. David says, when scaling in, oh, sorry, that's the same question. David says, oh, I do like a video we did on trading around a core position instead of straight scaling, like lobbing some in and some out. Also, how long does it take to put on YouTube? I think Pepperstone send out the recordings immediately, and then a few months down the line they upload them. I think it's up to those guys how they do it. But I think a few months down the line they'll maybe upload these to YouTube. Yeah, you know what? I might do a complete webinar on that, David, where you kind of working in around a core position, a little bit more advanced, and that sounds like the type of trader you maybe are. You add that core, you add a bit, you peel some off, maybe that bit's a scalp, you want to keep that core, you run that, you treat each as an independent trade. That can work well. Okay, so let's wrap this up. I think we've got everybody. Lee says, okay, got it. Thank you, Mark. No problem. Pal has helped. So individual trading is like life itself. Yes, Nuno, it is very. what a Nuno the philosopher. Yes, it is like life itself. Very personal things that we like to do. The other person might not like to do. How we feel about stuff. Yeah, you're quite right, pal. And being okay with that. And being okay with that is key in trading as well. Final question from David. How does positive visualization fit into your training and planning for scaling? Oh, this is a massive topic. Let me see if I can cover it in 30 seconds. I love this topic, and I think I've got a whole webinar on this recording, which you can check out on my website, Traders Mastermind, David. But you just want to put yourself into position. So mentally rehearse running through a trade that you want the outcome you want. Mentally rehearse the outcomes you don't want as well. Mentally rehearse how you respond. Here's a quick thing to do. Put yourself in a position. If there's an emotion you feel that you don't want to feel, you want to respond a different way. Let's say you feel like every time I'm up $1,000, I snatch at it and I feel nervous. Put yourself in a position mentally, visualize it. I'm up $1,000. I feel like I've got the urge to close it, and then you then rehearse how you want to behave, which is calm, push his chair back, relax, input whatever that is for you. That really helps kind of trying to rehearse mentally the stuff that you're trying to get good at. Amelie says, great, thank you a lot. No problem, pal. Two more questions. Mark, when you're going through a tough patch, how do you personally stay focused on executing trades without falling into the trap of doubting your whole system? You just got to think to the end of the week, the end of the day, the end of the period, and say, I'm just going to execute these trades. I'm going to award it. I'm not worried about the outcome. Very often, I liken it to driving a car, staring down the bonnet. You make all these corrections and you get so nervous. You drive, you look far ahead. You're looking multiple cars ahead. If you're on the motorway, you're like, hey, I can see this traffic here, and you're adjusting. You're not really worried about the tiny little mark on the road or the little pebble or something. Fine, there's a pothole, you want to avoid it. Bad analogy, but when you're in a slump like that or a tough patch, you go, right, 10 trades focused on this. This is important to me. 10 trades. Then you audit, and you don't worry about each individual trade. I know it's tough when you're in drawdown because it stings. Like, another one. Oh my God, I can't trade, and you get frustrated. But if you can stretch your timeline out to where you're focused and say, hey, I want to get 10 trades under the belt. I want to get another 10 trades under the belt, and think a little bit more long term. That helps you not worry about each individual trade or each individual day and the performance. And then when the markets are closed, you audit those trades and you say, hey, do I need to make adjustments? No? Fine. Because most of the time those thoughts come in the heat of the moment, like, I shouldn't be taking this. But if you can make a commercial decision in the cold light of day when the markets are closed, it becomes easier. You go, you know what? I do need to make a slight adjustment. Or you know what? No, I don't. I just keep pushing on. Okay, I think we are done. Final question. I'll get the last. Let's do them all. Should there be a percentage for scaling out position? Anthony says. You do what I think if you mean by percentage of the whole position, do what's comfortable for you. You might be like, hey, this is a really big level. I need to take most of the risk off. You might take 75% of the position off and leave 25% running. Like, you know what? I'll leave that. It's a free runner. I'll see what happens with it. Or you might be like, no, I need to just take a little bit off because it's nowhere near my target yet. I think it very much depends on the trade and very much depends on what you're trying to achieve, your strengths and weaknesses as well. If you've got propensity to take trades out early, then just take a little bit off. Just prove to yourself that actually holding it does serve me over time. Okay, we've run on, but thank you for your questions, guys. I really appreciate them. Great questions as always. Back next week, on Tuesday next week, I will fire out the topic and the registration link for you in the coming days. Otherwise, keep your risk managed, be patient and calm, plenty of opportunities, whatever you're trading. Thank you, ladies and gents. See you soon. Bye-bye.